Why did the British Empire, which governed a quarter of Earth's population and whose currency dominated global trade for over a century, collapse not through military defeat, but through a financial ultimatum delivered in 11 days? What specific sequence of economic decisions transformed history's most powerful creditor nation into a debtor forced to accept terms from international institutions it had created? And if this transformation followed such a clear pattern, why is the United States now replicating each stage of Britain's decline with striking precision? In October 1956, British Prime Minister Anthony Eden authorized a military operation in coordination with France and Israel. Egyptian President Gamal Abdel Nasser had nationalized the Suez Canal in July, threatening European access to Middle Eastern oil and challenging British authority in a region it had dominated for decades. The military operation proceeded successfully. British forces secured their objectives, Egyptian resistance was crumbling, and the canal would soon be under international control. Then, President Dwight Eisenhower intervened, not with American troops, but with American financial power. The United States government threatened to sell its substantial holdings of British pounds, which would collapse the currency. It blocked British access to emergency International Monetary Fund loans. Within days, Britain's foreign exchange reserves were depleting at a rate that would cause national insolvency within weeks. Food and fuel imports would cease. The economy would collapse. If you're watching from anywhere in the world, hit subscribe and let me know where you're tuning in from and what time it is there. I'd love to know who's following this story with me. Eden had no choice. On November 6, 1956, Britain announced a ceasefire and complete withdrawal from Egypt. The Suez Crisis lasted 11 days from British-French intervention to withdrawal, but those 11 days revealed what had been true for over a decade. Britain was no longer a great power capable of independent action. It was a financially dependent state that required American approval for its foreign policy. The empire that had dictated terms to the world for a century now accepted terms dictated by its creditor. Understanding how Britain reached this position requires examining decisions made decades earlier. The pattern that destroyed British financial dominance is remarkably specific, measurable, and currently being replicated by the United States, with little apparent recognition of the historical precedent. Britain's position in the 19th century was unprecedented. The pound sterling wasn't simply a currency, it was the global monetary standard. International trade contracts were denominated in pounds. Central banks held pounds as primary reserves. The City of London was the world's financial capital, where capital, credit, and commercial relationships were centralized. This created structural advantages. Britain could borrow at lower rates than any other nation since pound-denominated bonds were considered the safest assets available. It could run modest trade deficits without crisis because global commerce required holding pounds. It could finance military operations and colonial administration through debt that international investors eagerly purchased. This dominance rested on Britain's position as the world's leading industrial economy and largest creditor nation. British capital financed railways in Argentina, mines in South Africa, plantations in India, and infrastructure across 6 continents. Investment returns flowed back to London, generating wealth without requiring domestic production. By the 1890s, however, the United States had surpassed Britain in industrial output. American factories produced more steel, more machinery, more manufactured goods. American agricultural productivity exceeded British levels. The American economy was growing faster and would soon be substantially larger, yet the pound remained dominant. Why? Inertia. The global financial system was built around sterling. Changing would require new infrastructure, new contracts, new banking relationships. As long as the pound remained stable and convertible, there was little immediate pressure to switch. Then came August 1914. World War I transformed Britain's financial position catastrophically. The war consumed resources at rates that defied pre-war calculations. Britain borrowed massively from domestic sources and increasingly from the United States. By November 1918, Britain had transformed from the world's largest creditor, owed money by nations worldwide, to a major debtor, owing billions primarily to America. The rational response would have been accepting this new reality and adjusting policy accordingly. Instead, Britain made a decision that many economic historians consider one of the 20th century's greatest policy errors. In April 1925, Chancellor of the Exchequer Winston Churchill returned Britain to the gold standard at the pre-war parity. £1 convertible to £4, 86 pence worth of gold. The decision reflected pride rather than economics. Britain wanted the pound to be worth what it had been before the war, regardless of whether Britain's economy justified that valuation. Maintaining this overvalued exchange rate required keeping interest rates high, which strangled economic growth, increased unemployment, and made British exports prohibitively expensive in international markets. Economist John Maynard Keynes warned that the policy would be disastrous. He argued that the pound was overvalued by roughly 10%, making British goods uncompetitive. His warnings were dismissed. Churchill himself later acknowledged the decision as the greatest mistake of his career, but by then the damage was done. Throughout the late 1920s, Britain maintained this overvalued currency while continuing to spend as if it were still the world's dominant economy. Military bases spanned the globe. The Royal Navy remained deployed across every ocean. Colonial administration consumed substantial resources, but the industrial base supporting this expenditure was eroding. British manufacturers were losing market share to American and German competitors. Investment returns from overseas were declining as colonial territories developed their own industries. In September 1931, faced with speculative attacks and reserve depletion, Britain abandoned the gold standard. The pound's value fell approximately 25% within weeks. This was a public admission that the currency had been overvalued, that Britain could no longer maintain the pretense of pre-war economic dominance. Yet even after this humiliation, the pound retained significant international role. How? Through the sterling area, an arrangement where British colonies and dominions held their reserves in pounds and conducted trade in sterling. India, Australia, New Zealand, South Africa, and dozens of territories were essentially required to use British currency. Britain was leveraging its political control to maintain monetary relevance. Its economy no longer justified independently. World War II completed Britain's financial destruction. The war cost over £28 billion, more than Britain's entire annual GDP at the war's outset. By 1945, national debt exceeded 250% of GDP. Britain owed the United States over $4 billion. The economy was shattered. Industrial capacity had been converted to military production, and overseas investments had been liquidated to pay for supplies. In July 1944, while war still raged, Allied representatives met at Bretton Woods, New Hampshire, to design the post-war monetary system. John Maynard Keynes led the British delegation, proposing an international currency, the Bancor, that wouldn't privilege any single nation. The United States, represented by Harry Dexter White, proposed making the dollar the global reserve currency backed by gold at $35 per ounce. Britain, financially exhausted and dependent on American aid, couldn't contest this. The dollar replaced the pound as the world's reserve currency. The era of British financial dominance was formally over, yet British leadership continued acting as if the nation remained a great power. Military commitments continued across the Middle East, Africa, and Asia. Bases remained operational in dozens of countries. Defense spending consumed resources the shattered economy couldn't sustain. The government borrowed continuously to maintain these commitments, accumulating debt while the economic foundation continued eroding. This created the conditions that exploded at Suez. When Nasser nationalized the canal in July 1956, Eden saw it as a challenge requiring forceful response. He coordinated with France and Israel to launch military operations in late October. The campaign succeeded militarily, but failed catastrophically, politically and financially. Eisenhower was furious. He viewed the operation as old-fashioned colonialism that would drive newly independent nations toward the Soviet Union during the Cold War. More importantly, he recognized that American financial power could force British compliance without firing a shot. The mechanics were simple. The United States held substantial pound reserves and could sell them, flooding currency markets and collapsing the exchange rate. Britain's foreign reserves were already declining rapidly due to the Suez operation's costs and investor concerns. Without American support, Britain couldn't defend the currency. The IMF, dominated by American voting power, wouldn't provide emergency loans without U.S. approval. Within days of Eisenhower's ultimatum, Eden announced withdrawal. The empire had been brought to heel by its creditor. There's a common belief that Britain lost its empire primarily due to independence movements and moral evolution away from colonialism. While these factors mattered, the fundamental mechanism was financial insolvency. Britain couldn't afford to maintain colonial administration, suppress independence movements, and garrison troops globally. Each colony became a financial drain rather than a source of revenue. The empire didn't end through enlightened choice. It ended because the treasury couldn't pay the bills. The pattern that destroyed Britain's position contains specific elements that can be identified and measured. First, accumulation of debt that exceeds economic growth, transforming a creditor nation into a debtor. Second, maintenance of an overvalued currency through artificial means rather than accepting changed economic reality. Third, military expenditures that exceed what the economic base can sustain. Fourth, dependence on other nations, whether colonies or trading partners, to absorb and hold your currency. Fifth, refusal to adjust ambitions and commitments to match diminished economic capacity. The United States is currently replicating each element. Federal debt exceeds $36 trillion, approximately 123% of GDP and growing. Interest payments now exceed $1 trillion annually, consuming more than defense spending. The nation that emerged from World War II as the world's largest creditor is now the world's largest debtor. The dollar's global role persists, not because U.S. economic dominance is overwhelming, but partly through structural arrangements. particularly the petrodollar system where oil trades are denominated in dollars. This creates artificial demand for the currency, similar to how Britain used colonial arrangements to maintain sterling's role. But these arrangements are eroding as major economies develop alternative payment systems and conduct bilateral trade in their own currencies. USA. Military expenditures exceed $850 billion annually, more than the next 10 nations combined. Over 750 military installations span 80 countries. These commitments require continuous borrowing to maintain, exactly as Britain borrowed to sustain its global presence long after its economy justified such spending. Perhaps, most critically, there's widespread belief that American economic dominance is permanent, that the dollar's reserve status is secure, and that historical patterns don't apply. This mirrors British attitudes in the 1920s through 1950s, when leadership continued making decisions based on past status rather than present capacity. Britain's transition from apparent strength to undeniable weakness took roughly 35 years, from 1920 to 1956. The final revelation occurred in 11 days. The United States has been accumulating debt and running trade deficits since the 1970s, a 50-year trajectory. This suggests that when the inflection point comes, it may happen with similar suddenness. The specific trigger is unpredictable. For Britain, it was Suez, a regional crisis that seemed manageable until it revealed complete financial dependence on American support. The U.S. trigger could be a failed military intervention, a debt ceiling crisis that destroys confidence in government bonds, a geopolitical confrontation where financial sanctions prove ineffective because target nations no longer depend on the dollar system, or something entirely unexpected. What historical precedent indicates is that when structural vulnerabilities reach critical levels, relatively modest shocks can trigger rapid systemic adjustment. Markets in nations that appeared stable suddenly aren't. Currency that seemed strong suddenly faces selling pressure. Credit that seemed unlimited suddenly disappears. The consequences for ordinary citizens are material, not abstract. When the pound lost reserve status, British living standards declined significantly. Imports became more expensive. Inflation eroded savings. Services that had been taken for granted were cut. The comfortable middle-class existence many British families expected vanished within a generation. A similar adjustment in the United States would mean substantially higher costs for imported goods, which includes most consumer products, higher interest rates on all borrowing, and either reduced government services or higher taxes or both. This returns to our opening questions. Britain collapsed financially, not because enemies conquered it, but because accumulated debt and refusal to adjust to change circumstances made it vulnerable to pressure from its creditor. The specific sequence was decades of deficit spending, maintenance of overvalued currency, military overcommitment, and structural denial of changed economic reality. The United States is following this sequence with striking fidelity. Whether 2026 specifically marks an inflection point is unknowable. Timing is inherently unpredictable. What is knowable is that the structural conditions that preceded Britain's Suez moment are present in contemporary American finance. The debt trajectory is unsustainable. The military commitments exceed what the economic base justifies. The currency's privileged position increasingly depends on inertia rather than overwhelming economic dominance. And there's widespread belief that historical patterns don't apply to America. History suggests that such beliefs are almost always wrong. Empires that thought themselves exceptional discovered they weren't. Currencies that seemed permanently dominant didn't remain so. The question isn't whether adjustment will occur, but whether it happens through gradual recognition and policy change or through sudden crisis that forces change. If this examination of how Britain's financial dominance ended changed your perspective on current trajectories, I'd appreciate it if you subscribed. Historical patterns don't repeat exactly, but the dynamics of how nations accumulate debt, overcommit militarily, and maintain currency dominance beyond their economic capacity tend to follow similar paths, regardless of the specific nation involved.